everybody doing? This is Sergio Sais with the Real Estate Hedgehog podcast. Hope everybody's doing great. Hope everybody had a great Thanksgiving. As usual, I've got my partner here with us today. And Sam, how are you? I see that your hair is finally growing back, brother. I mean, all over the place it's growing.
Yeah, no, I'm doing good, and I'm feeling the holiday spirit. I got my Christmas red on.
Nice.
But with Christmas comes the end of the year, which means tax time is coming. So I'm starting to prepare my taxes.
Absolutely. In fact, I was starting to go through some of my files myself. And you know what's a little scary is I'm going through one of my files and I'm realizing, oh my God, where did that paperwork go? You know, it's like
Yeah.
you go through and you go, oh my God, I gotta find. So on one of them, I couldn't find the property taxes for one of my
Oh man.
properties. What happened? So I actually had to go online to the county tax assessor, and I was able to get them. But it's a
Oh
kind of a, you
yeah.
know what? It's a great thing to do before you really start doing your paperwork. It's just kind of going through each one of those accounts, each one of those files, and just make sure all the paperwork is there before you
That's what
start.
that's what I do. And speaking of which, you just reminded me, man. It's the first week of December.
Yes,
The second installment of the property taxes are due by next week.
exactly. And that's why that's what I was doing. I was
Yeah.
paying.
Hmm.
Anyways, um, today, this is part two of a three-part video set. Last time when we met, we discussed cash on cash and return on equity. And so if you recall, we were going to do cash on cash, return on equity. Then the second part is going to be what we're going to talk about today is going to be return on investment. So remember, cash on cash, return on equity. Both have been discussed. If you want to look at them, check our previous video. And now return on investment. And that is really when you start looking at the totality of your investment. What is your money that you've invested? What is the total picture? What is it doing for you? And so today, Sam and I kind of go through it. And I'll be just, like we usually do in every video, I'll be asking Sam a couple of questions because he somehow always has the answers, and I'll follow up. But Sam, why don't you start us off by just telling us kind of like the difference between return on investment and what we talked about last time, which was cash on cash and return on equity.
Well, I think you kind of summed it up with one sentence where what is your money doing for you, right? So last time we talked about cash on cash, which is the amount of cash you're getting divided by the amount of cash you spent to get that cash. So that was cash on cash. And then we had talked about return on equity, which is the amount of cash you're getting divided by the equity as a change year over year or month over month. And so that rate dwindles slowly but surely. And I remember the last time we talked, I told you that I start thinking about redeploying equity when I see that return on equity starts to dip below 5%. That's kind of my personal threshold. It's not a set rule. So now we go into the return on investment. Like you said, it's the totality of everything. But the way I look at the return on investment is, you got to ask yourself, what is the job of the investment? And essentially, in our case, since we predominantly talk about rental real estate, we'll use the rentals as kind of like an interchangeable with the investment. So what is the job of the rentals or those investments? That's what you got to ask yourself. Technically, there's really three jobs that at the core of it all is the job of the investment to get the returns. And that's, you get financial independence from your investments. That's what you're striving for. You want to build wealth, hopefully with those investments. And you want to be able to live off of that income, right? Then you ask yourself, well, how does this occur? And it comes up to really just two main steps. It is to produce income with the investment and to grow equity. So with that, I'll send it back to you. That is what the return on investment really encompasses.
Excellent. So when you're looking at return on investment, there are different components. Yeah, you talk basically, you said there's two main things, the cash flow and the equity. But in the equity and the cash flow, I know that we've all talked a lot about cash flow because I know cash flow, it depends on what stage of life you're in and what your goals are, that where cash flow can be either very important or it's just kind of a nice thing to have. But that's what can pay, if this is a business for you, as it is like in your case, that cash flow is actually what pays your bills and your, you know, day-to-day expenses and stuff. And I'm not talking about just for the properties here. I'm talking about what you live off of, how you know, pay your own bills and, you know, buy your food and pay for your kids' education, etc. So you've got that, but there are a bunch of other components that come into play besides cash flow and then building equity. So what would be, like, just give me one or two, just right off the top of your head, components that sometimes people don't think about them because it's not really in your face type of thing.
Yeah. So besides just the straight cash flow, you think about the pay down, because as the mortgage is being paid down, the principal is being paid down of what you owe on that mortgage. So principal pay down is a component people usually overlook. The other one is, you know, besides the cash flow, some people use the cash on cash return metric, you know what I mean, to get a percentage. But I also look at the tax benefits, because there's the depreciation, the deferment, the exchangeability. Those are the other stuff that you don't think about. And of course, the natural appreciation on the equity. So those are all components of income, believe it or not. It might not be tangible income, but it's part of the return on equity formula of income, because these are the values that you are now gaining from this investment.
And it's so critical to understand how important those are because, for example, the pay down on principal, sometimes people forget that when they're collecting rent, it's other people's money that's coming into you, and it's other people's money that you're using to pay that mortgage, which, like you said, pays down the principal. How cool is that? How I wish somebody was paying down the principal at my own personal house, right? So I can't do it on my own personal house, but someone else is paying down that mortgage and increasing the equity of that property with every rental payment. So I know that in on my spreadsheet that I have, you know, I have all of my expenses and then I have my mortgage payment. But then below that, when I'm trying to figure out what, you know, part of the total return is that pay down, because your invoice will tell you how much went to equity, how much pay down, or I shouldn't say equity, principal, how much money, whether it's 150, 250, 400, whatever the amount is, that's paying down, that's money you didn't have to use. So that's a very important principle. Now, you touched on something else there, which was the depreciation. Another thing that people have, people don't know how much that is per year. And so, I mean, it's a fairly simple formula, and I know we've mentioned it before, but why don't you, for our audience right now, what is that basic formula to figure out what your depreciation is on the property?
Yeah, so first off, depreciation is the wear and tear on the improvements of the land. So it's only on the building itself. It doesn't include the land. Generally, that is about 80% of what the value was, right? So you take that number and you divide it by 27.5. And that's kind of the general rule of how things degrade over 27 and a half years. Whatever that number comes out to be, that's what you depreciate against your earnings, you know, your income. So it does help you quite a bit. It takes a toll of the taxes, because think about it. If you have an asset that you're making money off of, but you're spending all this money on operations, however, you have just a little bit left over as profit, well, that depreciation can wipe out that profit on paper, and you don't pay taxes on the profit.
Absolutely. So as an example, when you said about 80%, so usually you have the land and you have the building, and usually the land is about 20% of the value, the building is about 40. So if you had a property that was $500,000, or at least let's say that and you're figuring about 100,000 of that is land, 400,000 is property. So you would take that 400,000 divided by, you said 27.5, right? And that means that now you have an additional write-off of $14,545 per year for those 27. And that is huge, because you're absolutely right. You know, if your taxable income was, let's just say, $5,000, just to have a number, right? On any given property, well, that 14,000 just wipes that right off the books. And then you can still carry over
I was gonna say that, I was
Yeah,
almost gonna say that. Don't forget, and this is getting a little too the weeds, but you can carry over,
yes.
So it's Uncle Sam doesn't forget, so should you not as well.
You should exactly, and so don't forget about that carryover because yeah, it's going to wipe out the tax hopefully, and there's going to be something left over, especially if you've got something like 14,000
Yeah,
in write up. So it does get carried over. So that's excellent. So all of that gets included in the total return of investment, right?
correct. So I
Yeah,
guess the follow-up question that I'm sure on most people's mind is, well, how do you get the best return on investment? What are the numbers, right? Now,
yeah,
it's
yeah,
kind of like what you opened this video with. It's different for everybody depending on your stage of life.
yeah.
But if you're looking at getting the best return on investment, there's two things you need to follow. One, buy at a discount, figure a way, get it undervalued because there's deferred maintenance, desperate seller, whatever it is, we can go down that hole. The second
Mhm.
part is your strategy. So that's it. It's a two-part formula to get the best return on investment. Buying at a discount, and then what is your strategy for that specific asset? Are you going to flip it? Are you going to hold it long term for major equity growth and milk out that depreciation? Are you going to exchange it? Whatever that strategy is, that's up to you. But those two components will determine how to get the best return on investment.
So when you're looking at your best return on investment, just on the typical sort of property that you've had, what
Yeah.
is that number that you at least that you have in mind, if not in reality?
So in my mind, it's a minimum of 15%, but in reality, it's usually about 20 to 25%. And the reason why I say that, so there's this old saying, right? I think it goes something like this. If you need a computer or a calculator to make the calculations, you shouldn't buy it. And I'm not saying
Okay.
don't go on a spreadsheet. All I'm saying is you should get the gist, kind of like the round numbers on a quick glance on the back of a napkin of what you're about to buy. If you can do it and it stands out and it pops,
Right.
this is a good deal, I'm going to tell you it's a good deal. But if you have to dig into the weeds and fine tune it to make it a good deal, it's probably not a good deal. So when I say 15, 20, 25% on the ROI, I've already factored in the vacancy, the maintenance, the property management, all that, and at a glance, and I know that this one is probably going to make me a roughly 20% ROI. And I say that because my minimum is 15. That way I know that my investment doubles every 5 years at the very latest.
And that kind of covers everything. I mean, as far as what we're going to cover today on return on investment, because as you and I were talking about before we came online, is that on any one of these things that we talked about, you can go down some rabbit hole and really dig really deep down. But we don't have the time for that right now, and I think it could be discussed at some other point because a lot of these issues, whether it's depreciation, whether it's how to buy at a discount, whether it's how to maximize your cash flow by minimizing expenses. All of those things can be discussed at a future date. But this is a great overview. And I just want to make sure that people understand that when you are looking at a property and you're doing your numbers and you're going, oh man, this property only returns maybe 4, maybe
Yeah.
5%. Think the bigger picture, right?
Yeah. 5%, just quickly can really be 15 to 20% when you look at the big picture, because you look at the principal pay down, you look at the appreciation, you look at the tax deferment, all these little percentages add up, and then next thing you know, your full return on investment is 15 to 18%.
Exactly. And really, the cash on cash is just a small part of that wealth building thing that we're all trying to accomplish.
Oh yeah,
So
exactly.
yeah, so don't be discouraged if you're seeing, especially right now with interest rates being kind of a little bit on the higher side and people getting a little frustrated with that because prices don't want to come down. But still, there is that. You got to look at the whole picture, and you may be missing out on some great opportunities